Well, thanks for tuning in this conversation on the sidelines of the JP Morgan India Investor Summit. And we're speaking to somebody who's now not irregular face on BQ Prime. It's our pleasure to talk in person with Pinakin Parekh of JP Morgan. Pinakin, great having you.
Thank you, Neeraj.
So, Pinakin, multiple things to focus on. Maybe let's start with energy. Clear and present danger for economies and spaces. What's your sense of what's happening there and how could it impact the players in the ecosystem?
Sure. So I think we need to break down energy into two components, oil and non-oil. So oil prices have pulled back 20% on worries of demand, on worries of new supply starting back up, and they seem to have settled in the $90 handle. We believe at JP Morgan that probably oil should stay between $90 to $100 a barrel. We do not forecast a big decline from here, unlike some of our peers. The problem is not oil. The problem is non-oil. So gas, diesel, and coal. All are at near multi-year highs. And that's a very specific problem related to Europe. If European supply situation does not ease out of Russia and the winter is still ahead of us, then we could see prices remain strong. That impacts demand. We have seen India's gas consumption in August decline. Coal imports have fallen. And the worry is what happens next year, because this year's storage is somehow taken care of in Europe. Next year, if these supplies don't start, then the entire non-oil complex could remain firm. I mean, we are not used to $400 thermal coal prices.
Yeah, we aren't. So, okay, just lay this out for us, because I heard you mention that this year's supply is taken care of. Or do you foresee this to be a prolonged pricing problem, one? And in some case, yesterday I was reading a Bloomberg article which said that Indian gas costs have also now surged as well. So what does this specifically do to the Indian landscape?
Sure. So, I mean, when I say this year's storage is taken care of in Europe, it assumes a normal weather. If you have a Six Sigma event in terms of a colder winter, then obviously all bets are off. Then Europe will try to pull in as much gas it can in the spot market. That spikes up spot LNG prices further. When it comes to non-oil commodity imports in India, you're talking about gas, you're talking about coal. Remember, most of our consumption is domestically priced. So if you are sourcing coal from domestic coal, you're okay. It's on the margin, the 15-20% of buyers who rely on imported spot prices. And they surely just can't compete at this point of time. So the easiest way out is, if you are a power plant running on imported coal, you back down. If you are a fertilizer company who does not have a back-to-back, then you back down. And I think this is a problem which could accelerate if European situation does not ease off anytime soon.
Okay, so in which case, what is the equity hypothesis? Because I remember you were amongst the first ones to kind of foresee how some of the oil price gains are here to stay. The upgrades came in on the upstream companies and they did well for a reasonably strong period. Yes. So energy broken into two and different components there. What's the equity thesis?
So the way we look at it is that you are better off staying with the refiners, especially those refiners who export. So there are two elements over here. Is the commodity price risk to the downside or upside, and in which commodity? And second, do you have regulatory risk to the business model? So you want to stay with businesses where you have the maximum upside risk to the commodity, what you're doing. So if you're a refiner, refining margins outlook is still relatively strong. If you're a gas producer, then the outlook to the gas price is better. And where the regulatory risk is relatively lower. Now, if you're an exporter, you are still better off. So what has happened is, in the India energy space, policy becomes a big overhang, and that is what is impacting stock prices.
Yeah, and but you should continue to stay. In which case?
So my sense is that you go to the second order derivative. So instead of buying energy, you look at metals, because when energy prices stay high, metal cost of production will remain high. So metal prices would also remain high. So you're better off with metal producers who benefit from higher energy prices. If you are an aluminum producer, aluminum prices go high. That is, I think, the way to look at the value chain.
Can I probe this a little? So metals have had an interesting last 18 months, right? A ferocious up cycle, followed by a bit of a down cycle that has come in. Now maybe a bit of a stability, but prices are still very volatile, to say the least.
Agree.
So how do you build this hypothesis?
So I think the volatility is inherent. That's not going to go away. But take a step back. $2,300 aluminum, which is the price today, was the cycle high price in 2018. It was a 10-year high price. $600 steel prices used to be the high prices for steel. So what has happened is that the cycle has reset higher, but there is still an inherent volatility which will stay depending on the consumers destocking and restocking. So a $300 to $500 steel price range has probably moved to $600 to $800. Aluminum has probably moved higher. In that new cycle, we are at the lower end right now because the last 3-4 months seasonally are always very weak globally. There's destocking which happens in Asia because of rains. There's destocking which happens in Europe and US. Now we are entering this busy season, and we need to wait and see as to how the expectation of a recession next year
Precisely.
clash with the on the ground demand at this point of time. Because while everybody expects demand to be weaker next year, so far we are not seeing signs of demand weakening this year, and inventories are low. Consumers destock, expecting prices to fall. So when you start consumers coming back, China's seasonal demand picks up. Where do prices go from here?
Wow. So yeah, I was going to say that post China's big election moment, maybe there, if normalcy returns, plus what you're talking about, the inventory levels destocking, are you therefore constructive on not just aluminum, but aluminum plus steel plus?
So we are constructive on metals per se. And our view is that, look, the last 18 months or starting from 2021 second half, Chinese demand has been negative. Whatever metal prices you saw because of demand from the Western world. Chinese demand on the margin has stabilized and will improve. We can debate the pace of improvement. And in metals versus energy, China is 50% of metals. So even a marginal improvement over there tends to lift overall demand. And the supply side thesis are still not gone out. And in fact, you have hydropower shortages in China, you have coal shortages, you have gas shortages in Europe. So the worry is that if demand in US and Europe does not fall off the cliff in the next 3 to 4 months, and Chinese demand improves on the margin, then prices, the only way up is higher.
Wow. So, Pinakin, tell me, there are some people who look at metals closely as well, who believe that the trigger for these companies, irrespective of what happens to fundamentals, is what the Indian government does with the removal of the taxes that were levied.
Sure.
Would you believe that is the immediate?
So I would put it this way, that if you're looking for an immediate catalyst, obviously that will be number one. Having said this, if you have steel prices going higher, and to be fair, the policy response was a short-term response in response to higher prices. Prices came off in the domestic market. So we are debating the time at which it gets removed. I don't think it's here to stay permanently. Remember, steel, iron ore exports would account for $10 to $12 billion a year. They are down very sharply. You have a currency which is depreciating. So I think policymakers understand that you don't want to switch it off completely. And plus, these are the companies who are doing large capex. So it's a question of time when the export duty goes away. If it coincides with better Chinese demand, and if you look at stocks which have relatively underperformed, earnings expectations are weak, and then again you have the herd go the other way.
But you would believe that even if the export taxes were to stay, if demand picks up and prices internationally move up, with being at the low cycle of the new reset valuations, there is a possibility of gains there.
Yes, I think at the end of the day, it comes down to earnings expectations versus an investor positioning. The domestics are underweight the space, the foreigners have sold off, and if the downgrade cycle does not come through and we still have an earnings upgrade cycle, and China does not look that bad, then as a momentum trade, it comes back.
I take on board that you are telling your clients out here to watch out for this space very actively.
We are, so between metal, cement and energy, I mean, we see fundamentals the best position for metals in terms of what the stocks are pricing in and versus what the on-the-ground situation is.
So I was going to wrap up this conversation with cement.
Sure.
Because it's such a hot space of late
Yes.
because of what's happened.
Yes.
Now, is your base thesis that there is heightened chances of M&A activity?
So the stock prices are telling us that the markets believe that there is going to be consolidation. Now, my limited 2 points are, I don't know who will sell and who will buy. But historically, if you look at the space, the only time we have seen M&A take place is generally when you have had stress. Companies have had leverage, they had to go through NCLT, and that is when there was a forced buyer and there were willing buyers. Now you do not have stress. If you look at the listed companies, 16, 17 cement companies which are listed, very few have debt, and even their debt is manageable. Today's profits are maybe lower than last year, but are near cycle highs, and the demand outlook is strong. So if you were to put yourself in a seller's place, I mean, there is no push for him to sell. The question is that if he gets a very high price, then does he blink? But if you have a very high price, then why would a buyer buy the asset? He can go and build an asset. So the stocks are telling us that there is M&A, but when I look at fundamentals, it does not look like that. So I think what I will focus on is the capacity addition. I don't want companies to keep on announcing capex, because if that is happening, then there is no consolidation happening through.
Got it. What about the space per se? I mean, are we entering any kind of a cycle or an end of a cycle or something like that?
So it is interesting in a sense that obviously the demand outlook is very strong. Having said this, if you look at the next 2 to 3 years announcements in terms of capacity additions by cement companies, it is the highest ever we have seen in the last 15 years or so. Every single cement company is working on an expansion project on the ground, and you are bunching up of capacities. So what you don't want is, for whatever reason, demand weakness on the margin or being lower than what was expected, because there is a lot of capacity coming through, which was not the case for the last 3 to 4 years.
Which something tells me in your answers that you are sounding net neutral on the space at large, especially after the run-up.
Yes. So our view is that if you look at cement stocks, every single one of them is trading at near lifetime highs in terms of EV/EBITDA, which is the earnings-based metric, or EV per ton. So the stocks are pricing in a lot of earnings momentum, a lot of re-rating, and the fundamentals on the ground marginally will slightly deteriorate in terms of supply demand. So if you're buying a stock today, you are expecting a breakout in terms of consolidation, you're expecting a breakout in terms of supply not coming through. The risk reward is not in favor at this point of time.
Okay. My final question is, what happens to the cost structures of all of the three spaces that we've spoken about in light of the hypothesis that you have about what could happen to commodity costs by and large around the world over the course of the next 12 months?
I think the next 3 to 6 months, we'll see cost structures come off because of what had happened to coal prices in the last 3 months or so. Petcoke fell, oil fell. But over the next 12 months, if I were to take it, I think the cost structures will remain elevated. So what you're probably going to see is costs come down in the September-December quarter and then rise up again next year. So versus the markets expecting that, the commodity cycle is over and we are in for a cost deflation cycle, which may not be the case.
Why so?
Simply because you need the entire energy supply from Russia to go back to normal. And you need to see demand weakness for commodity prices to fall further from here. And as I said, if Chinese demand next year is better than this year and Russian supply does not come back, then where are you left with the prices?
Got it. Fascinating. Thank you so much,
Thank
Pinakin.
you.
Lovely talking to you as
Sure.
always.
Thank you.
And viewers, thanks for tuning into this conversation.